This video discusses bank reconciliations. Bank reconciliations are a key internal control that a company uses to identify differences between the accounting records that it has for its cash balance and the records that the bank has for the cash balance of the company. In terms of internal control principles, bank reconciliations would fall in the category of independent verification. We are using the banking records to independently verify the records of the company. If you've ever experienced the feeling of looking at your bank account and thinking, there should be more money in this, or maybe there should be less money in this, although it's probably the former that we usually gravitate towards. A company is no different. A company will look at its bank records and compare it back to its company records and find differences. And the bank reconciliation facilitates a reconciliation between those two numbers. So the overall general idea that we're going to do is we're going to compare the book value to the bank value. It's expected that these numbers are often not the same, hence the word reconciliation here. And our goal is going to be to identify the differences between the two and make sure that they are reasonable in terms of their explanations, that there's not any errors or any fraud that's going on. And then from the book side, those items that we don't know about from the company's records, the book records, that we learn about from the bank, we are then going to create journal entries for to ensure that our book records are then up to date. We never create the journal entries for the bank side because we, as our own entity, are not the bank. We use the bank as the independent verification, but we wouldn't make journal entries for the bank. So we only, in this process, make journal entries based on the results for the company. To illustrate this process, I've got here banking records from Texas Commerce Online Banking for the entity that we're going to be looking at, and I have cash records that are coming from the book. What you can see is that the ending balance on 6/30 on the bank and the ending balance on 6/30, we're doing June 30th, 6/30 on the book is right here, and these items are different. So what the reconciliation is going to try to do is to identify why there are differences between these records. To do this, it's helpful to note that we have two types of reconciling items: those that impact the bank. In other words, they're items that the book knows about. The book knows about, but the bank does not. So the bank is not aware of things like deposits in transit that we often call DITs, as well as what we call outstanding checks. Deposits and transits are where you as the company, and I say whenever I refer to you, I'm talking from the company's perspective, you as the company make a deposit to the bank, but the bank has not yet processed it. This might happen, for instance, an overnight deposit or something mailed to the bank, or perhaps even that a check for a larger dollar value was deposited through the ATM and the bank won't recognize fully that value of the check yet until it has time to physically process it. These are what we call deposits in transit. They're things that the book knows about. In other words, the book, as soon as it received that money, it debited cash and credited the other side of the account, which, let's say, for instance, it was revenue. As soon as they received a check from their customer, this is the journal entry they did, increasing their cash account. But the bank, it won't increase the banking records until the deposit is fully in transit, fully processed. Thus, we consider it a deposit in transit. A similar item, but sort of on the reverse side, is what we call outstanding checks. And those are instances where the company has written a check to a vendor or someone they have to pay, but the check has not yet been presented to the bank. For instance, if a company writes a check to pay, let's say, advertising services, its journal entry is debit advertising expense, or maybe it was previously on accounts payable, so debit and accounts payable, and credit cash. This is the journal entry they do as soon as they write a check. However, this decrease in cash that happens in the book records will not be reflected in the bank's records until the bank is actually presented with the check. The company will have to, the vendor will have to present this check to the bank, and the bank will then have to process it in order for the account to go down in the banking records. But the book will record the reduction in the cash immediately as soon as the check is written. And so again, there's timing differences that exist. These are the items that the bank doesn't know about, but the book does know about. And then you've got the reverse side. The reverse side are the items that the bank knows about, but the book does not know about. They may not know about it. And so what items are these? Well, for instance, interest that shows up on the bank statement before it's recorded in the books. So the books, the company may be able to calculate interest, although it can be a more complex calculation because banks often will accrue interest on a daily, they'll compound it on a daily sort of basis or a monthly sort of basis. But regardless, the bank will deposit that interest directly into the account of the account holder. Thus, it will often show up on the bank statement before the book has it in its records. And so interest is a common timing difference here. Another one is electronic funds transfer. We often call this EFTs. EFTs represent where money is directly deposited into the bank account of the account holder. Again, it's not that the book maybe necessarily doesn't know about this, but it may not know that it's already been converted into cash. For instance, they may have an accounts receivable recorded, but didn't realize that they actually got the cash until it showed up in the bank statement. Common example of this is direct deposit. So you all probably work a job, you receive direct deposit where money is directly put into your account and you see it in your bank statement first. Even though you might know that it's coming, you see it in your bank statement first before it shows up in your records. Another one is service charges. Service charges can happen where the bank charges the customer, the account holder, a fee for one reason or another. You might think, well, in your own personal checking accounts, you're not often charged a fee. And that's true. In personal checking, you're not often charged a fee. But in business checking, you often are. And so it can be a fee for a number of different reasons. There could be overdrafts. There could be multiple different reasons why fees exist. But with business accounts, often there is a fee for maintaining the accounts, usually because it's higher dollar value, usually because there's a lot more volume of transactions. But either way, these fees will often show up in your bank statement before you have them in the accounting records. Oftentimes when you get a fee, you're especially if it's a fee that's not related to a standard sort of charge, like a monthly service fee, then it's unexpected. And so often the bank statement will reflect that before the book records will. Another one could be customer checks that you deposited in your account because you thought they were good, but it turns out that the customer that paid you didn't have sufficient funds in their accounts. This is often what we refer to as an NSF check. These insufficient funds checks are reflected in the bank statement before they're reflected in the books. Obviously, if the customer wrote you a bad check, a check that had insufficient funds, you wouldn't count that as cash if you knew it was going to be cash. Thus, these items are reflected in the bank statement. You as a company will find out about them through the bank's information, which will show up in the bank statement, again, showing differences between the book and the bank records. The final one can show up on either side, and there are other reconciling items. These are some of the most common ones and the ones we deal with in this introductory class. But another one that can pop up on either side, either the bank or the book, is errors. Both sides of this sort of verification, the bank records, the book records, they're both ultimately going to come down to humans enacting this process, and we are not infallible. So there could be mistakes that are made on either side, and so those errors could reflect reconciling items as well. Okay, let's see how this reconciliation plays out. So we've got the banking information over here. We've got the book information over here. When we look at the banking records, the starting point is this $10,638. This amount is the starting point at our bank side to the reconciliation. So this is the reconciliation that we're doing. The book value starting point is the ending balance over here, this $11,391. This is our starting point at the book side here. We can see these two are different. So now we're going to look for the reconciling items that we talked about up here. What are some of the items that the bank doesn't know about, but the book does? Well, for instance, deposits and transits and outstanding checks. But how do we find those? Well, look at the information brought in the bank statement. We have withdrawals, which are essentially checks that are written. And then we have deposits, which is money coming in. In the book side, we have a debit side and we have a credit side. So what we're going to do is identify that the debit, makes the cash go up and the credit makes it go down according to the book records. So we have deposits that are listed right here, and we can compare those back to the deposits we have over here to see which ones might be in transit. So this 3,000 checked here, 500 checked here, 1,800. I do not see that as a deposit. It makes sense that this would be in transit because it happened on June 30th. So this becomes our deposit in transit. We'll do the credit side as well. So our withdrawals here, we've got the 500 check, which is check number 100. That's here. The 55 here. The 100 here. The 18 is not there. It looks like 18 was NSF, so we'll deal with that here in a minute. Then we'll go to check number 145, or amount 145, check number 103. That one does not look like it's present over on the banking side as well. So this one is going to be consideration for outstanding check, and you can see that listed here. And then we'll keep going down. The 56, check 104. We do have check 104 here, but it looks like the amount's written for 65, not 56. So it seems like someone inverted the numbers there. So that looks to be an error. Move on to the next one, 815. This was written on June 30th. That one does not show up in the withdrawal, so that would be another outstanding check, and it makes sense. This is on June 30th that it hasn't yet been cashed because we're doing this as of June 30th. So these two are outstanding checks. We'll then move on to the book records. We're going to save the error for consideration last. You always want to consider errors last because we don't know if the book or the bank made the error. We can find that out as we go through the process, but we consider errors at the very end. All right, so now we're going to go to the book records. We're going to look at the bank side to know what the bank knows about over here, but the book does not know about. So notice we started from the book side to learn what the bank didn't know about. Now we're going to start from the bank side to learn about what the book does not know about. Let's start with deposits. So with deposits, we've already accounted for the first two that we have listed here. Let's go to the next one, which is 20. This one represents interest earned. So when the book learns about interest being deposited into its bank account, it will then record a debit to cash, increasing cash. So this is an addition here. Keep going down the list. The next one that we haven't checked off is this 100, which is an EFT deposit. Electronic funds transfer, or an EFT, is where money is directly deposited in your account. So again, when it goes into the bank account, the company will debit cash to increase its accounting records for cash. Therefore, it is an addition to this starting balance. Our starting balance is before we took into consideration the information from the bank. What was our cash reflected as? Now that we learned some information to make, we're going to make adjustments to that starting balance so that the two balances at the very end from the bank side and the book side will reconcile or agree. All right, looks like we handled all the deposits. Now we're going to go over to the withdrawals. So withdrawals, we'll just sort of go down the list. The first one that has not yet been checked off is the NSF check. The NSF check means that the bank realized that the check that was written to the company where the company increased its records was not accurate. It did not have sufficient funds. Therefore, it pulled that money back out of the bank account. Originally, it deposited it in there, assuming the funds were good, and then learned it wasn't, so it pulled it back out. So that is going to be a reduction to our book records because when we received the check, we debited cash. We thought that the check was going to be good, and that increased the cash. But it turns out the cash wasn't actually there, so we have to reduce that starting balance. The next one is the bank service charge. The bank service charge that we have here is 6. That service charge, when we find out about it from the banking records, is going to reduce our cash again. So we have a deduction from the starting balance because we have not taken this out yet. The final one is going to be the error consideration. Now, the error consideration shows that we have $56 written here, but the bank saw that the check was written for $65. So in that instance, the bank saw the check, saw that it was written for $65, but we wrote it in our records erroneously as $56. In other words, the book made the error because they erroneously wrote their accounting records. The bank will always cash the check for what the check is stated for. So the check was supposed to have a withdrawal, meaning reduction in the cash account, of $65. We only reduced our cash account by $56, which means we need to reduce it by $9 more in order to match the banking records. So this error correction is going to be reduction by $9. I always tell students when deciding how to handle errors, do two things. Ask yourself two questions. Question number one, who made the error? If you can figure that out, it gives you a 50-50 shot. If it was the bank that made the error, make the adjustment here. If it was the book that made the error, make the adjustment here. Then the second piece is to ask, how do you fix the error? Because you're only going to make an adjustment to fix it. You're not going to back both things out. You're going to instead just make an adjustment to fix it. And in this case, what we saw was that we only reduced cash for 56. We needed to reduce cash for 65. So to correct the error, we reduced cash by $9 more on the book side because the book was the one who made the error. And then again, you can see at the bottom here, we've got 11,478 on each one of the reconciled sides here, which means that we've captured, hopefully, all of the items that cause there to be a difference. If we haven't, we know, number one, we've made a mistake, or number two, there's some fraud or error going on that we're not for sure, that we can't explain. And so there's follow-up questions that are needed. And again, that's why it serves as a purpose for internal control. Our final step would be for us to record our journal entries associated with the book side. So you can see here we recorded the interest, which is this piece right here, by debiting cash and crediting interest revenue. And the idea is that these journal entries are always going to impact cash in some way because we're looking at the cash account in the company's record. So here you can see debit to cash because that was an addition here. Here you can see a credit to cash because that was a deduction here. And so we'll go along the lines and simply make the journal entries for the standard journal entries you've been doing to take into consideration their impacts on cash that we didn't know about, but we learned about during the internal control bank reconciliation process from the bank records, that independent verification.